Hi, my name is Norma Brickner, and I'll be talking about the Walt Disney Company. Disney Corporations is a multinational, diverse media conglomerate that dominates both the entertainment and the media industry. I also found, through the Walt Disney Company SWOT analysis published in 2019, that they're located in Burbank, California, in the U.S. The Walt Disney Company is the world's second largest media conglomerate at $22.5 billion, behind Comcast. The Walt Disney Company continues to entertain children and adults alike around the world with their original content and characters, and even with the content provided with their holdings. Because the Disney Corporation has a low number of competing corporations, each competing company in the media market is able to capture economies of scale, reducing their production costs and giving them the ability to offer services to customers at discounted costs, which I also found in our mass media textbook. So Disney Corporation has acquired some intense competition over the years, including Time Warner, Viacom, CBS, Comcast, DreamWorks, Lionsgate, Marriott International, and Starwood Hotels and Resorts. Their television and radio stations primarily compete for local audiences in local markets. So in this graph that I found displaying 2017 revenue at Free Press, I found that if you combine Walt Disney and 21st Century Fox revenue, then you'll get about the same amount of revenue as Comcast corporations, which is pretty much the only major media company Disney is up against. So Disney's main line of business is entertainment through media networks, and the company also operates resorts, hotels, vacations, clubs, and cruise lines. They provide studio content and entertainment, such as animated motion pictures, direct-to-video content, musical recordings, and stage plays. So since about the 80s, media corporations have shifted from demographic to overseas investments in less developed countries, because that's where the media market is in flux. Disney has operations in US, Canada, Europe, Asia Pacific, and Latin America, but they market their media worldwide. I made this chart with the data I found at Disney Corporation's 2019 annual report and the SWOT analysis also published in 2019 to display that Disney mostly gets their money from these primary markets, and the other sources are only affiliate fees, advertising plot fees, and licensing fees. Over 73% of Disney's revenue from these media markets comes from the US and Canada. So this overdependence on those geographic regions makes Disney more susceptible to adapt to the political and economic changes of those areas. Amy Watson at Statista.com estimated the industry revenues at $720 billion, and I found the company revenues in the 2019 annual report at Disney. Displayed is the company revenues divided by the industry revenues, giving me a 9.6% market share. Disney recently acquired outstanding capital stock of 20th Century Fox, increasing the number of film titles available for distribution. Disney has acquired their film production businesses, their television creative units, and their acquisitions in other media groups, including their 30% interest in Hulu. So Disney has an increasing amount of debt mostly because of the acquirement of 20th Century Fox at $69.5 billion. This was predicted in the 2018 annual report. Through this acquirement, they got lots of creative content, technologies, and talent. Through the acquirement of 20th Century Fox, Chairman and Chief Executive Officer of Disney Corporations, Robert A. Iger, says that this will be incredibly transformative and dynamic because they have started competition with Netflix and Amazon between Disney Plus and this acquirement of new films and productions. So displayed is that the revenues for the Walt Disney Company and the profits have been fluctuating since 2017. Disney Corporation benefited from the Tax Act because of a higher segment operating income tax, and the decrease in profit between 2018 and 2019 is because of the consolidation of 21st Century Fox. So with this chart I created, I wanted to point out that even though Disney has a selection of media networks, experiences, studio entertainment, and streaming services, they can only go off of about half of that right now because of the recent outbreak of COVID-19. They cannot go to the studio to produce any more content. So, the prospects of this company in the next few years is that I would think that they would have recovered quickly from the financial debt that 21st Century Fox put them in. But because of the recent outbreak of COVID-19, they are not able to operate their facilities, which generate most of their revenue. So here I wanted to emphasize that with the long list of parks, experiences, and services that Disney offers, that is where most of their revenue comes from. Most of their revenue comes from the services that they offer, and little comes from the products that are streaming or that are studio entertainment. So, through this graph that I found at the BBC, originally published in 2018, I wanted to show that Disney makes most of its money at parks and resorts they provide. Media networks stand at a close second, but bottom line is they do not generate as much revenue. So, with the information I found at the Walt Disney Company website, in the annual report, it was predicted that they would make a speedy recovery from the debt that 21st Century Fox put them in. But they had to pay $511 million to get partially out of debt, and they're still making payments through shares. So we went over the overall financial state of the company and the revenue that they generated and the acquisition of 21st Century Fox. We know that the Walt Disney Company belongs to the media industry and that they focus more on buyer concentration. Also, Disney is timely, so no matter what, it's always going to appeal to adults and children.